On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Hi, team. Hope everybody is well. Let's take a quick look back at last week before we turn our attention to the week ahead and talk about what's coming up. It was another very good week for investors, with shares and fixed income both rising solidly. We'll talk about share markets first. The US S&P 500 added another 0.8%. European shares were up 1.4%. The UK market gained 0.5%, as did Australia, up 0.5% too. And the local NZX 50 here in New Zealand rallied 1.4%. And that was our fifth weekly gain in a row. So it's been a nice little recovery. November lived up to its name as a very good month for share markets around the world. The US market rallied 8.9% during the month of November, and the local market posted a gain of 5.3%. So those were the best monthly figures that we've seen since July of last year. And if we look at where markets are at year to date, and we'll just focus on the US and New Zealand, but most of them are looking pretty solid. The US market is on track for a gain of 21.5% in 2023, including dividends. That would be the sixth strongest year of the past 2 decades, and more than double the average over that period, which is 9.5%. The local market, on the other hand, has been much more subdued, and it's, to be honest, one of the weaker markets around the world in 2023. We're actually down slightly at the moment, not much, less than 1%, but still down. And we're flirting with our third consecutive negative year. We saw a marginal decline for the local share market in 2021. And last year, like most asset classes, we were down about 12%. So even though that was a pretty small decline in 2021, and this year we're only down marginally again, down is down. And we haven't seen 3 straight declines for the local market as far back as records go. So with a bit of luck, now that we're on the home stretch in December and we've strung together 5 good weeks, that optimism can continue and we'll hopefully drag ourselves back into the black before the end of this year. It wasn't just share markets that performed well. Bonds were also strong. We saw the 10-year US Treasury yield finish the week lower again at 4.2%. That was down from 4.5%, or just shy of 4.5% a week earlier, and the lowest in 3 months. And lower yields means higher prices. So those lower bond yields, lower fixed income yields are seeing better performances from those assets. It wasn't long ago, it was actually just early October, I think it was, wasn't it, that we saw the 10-year yield push above 5% in the US. And that was something we hadn't seen since 2007. So after being at a 16-year high of just above 5%, we're now down at 4.2% for that 10-year US Treasury yield. So it's been a pretty big move down. Local interest rates also fell slightly, not by much, but it was interesting that they fell at all when we did get that hawkish rhetoric from the Reserve Bank last week. We'll talk about that shortly. But the local 5-year swap rate finished the week at 4.78, which is a little lower than where it started the week. And fixed income also had a great month in November, around the world that is, not just here, but US bonds posted their best monthly performance since 1985 with a 4.5% rise, and global bonds rose the most since December 2008 with a gain of 5%. Government bonds here in New Zealand had also their best month since 2008 with a rise of 4.1%, and New Zealand corporate bonds posted a gain of 2.7%, which was the strongest month for that index since it came into being in 2001. Looking at the key releases from last week, and the obvious one was the Reserve Bank here in New Zealand. For us, that was the main event, and it didn't disappoint. Nobody expected the OCR to change, so that was left on hold at 5.5%. That was widely expected, and it was the fourth meeting in a row that the Reserve Bank hasn't changed its OCR. The last increase came back in May. That took us to 5.5%. That's where we still are, the highest since '08. Not nearly as high as we got to before the GFC when we reached 8.25. But remember that this cycle has seen the OCR increase much more quickly than we've seen in the past, and that has been important. So, no change in the OCR, which made it all about the forecast. And the new forecast didn't disappoint in terms of giving the markets something to talk about. And the one that mattered the most to everybody was what would the Reserve Bank do with its OCR track, its official cash rate forecasts for the next few years. And it ramped these up much more than people were expecting. I was expecting them to hold the line and stick with what they had in the face of expectations that have built around earlier rate cuts. But they did more than just stick with what they had. They actually ramped those forecasts up quite a bit. They now see a good chance of one additional rate hike next year. Before, they just had sort of a smidgen of a chance. Now they're saying, look, there's about a 75% chance. And their rate track doesn't have the OCR falling below its current level of 5.5% until the second quarter of 2025. So, sort of 18 months from now. And if you look at the end of 2025, so 2 years ahead, they've got an OCR penciled in of 5%, which is a full 0.5% higher than what they had back in August. So they've lifted that rate forecast track up across the board, really. What are they so worried about? Why have they done that? Because remember, the last inflation report came in weaker than expected, didn't it? It came in at 5.6%, and the Reserve Bank was expecting 6.0. So, what's changed? Well, I think migration is a big factor. They talked a lot about migration in the report and at the press conference. And they're obviously worried about some of the impacts this will have on activity levels and house prices and things like that, rents, and that could put upward pressure on inflation. And all of that's true, but something they didn't talk about much, but I think is something important to remember, is that high migration is also helping ease labour market conditions. One of the reasons we've seen the unemployment rate increase from 3.2%, beginning of last year, which was the lowest since the early 1980s, to 3.9% today. It's quite a big jump. Is that it's become a lot easier for businesses to find staff because we've got more people coming into the country and looking for jobs. And that has taken the edge off wage growth, which is expected to lead to lower inflation more generally. So I think that's important, but it didn't get a whole lot of attention. Something else I think that we need to bear in mind is that the Reserve Bank wants to keep the foot on the brakes. The last thing they want us to do is relax and stop worrying about high interest rates and tighter monetary policy. They're telling us what they want us to hear. So they don't want to see a behavioral change after they've done all this work to make us a bit more nervous and our lives a bit more painful. They want us to expect that our lives will continue to be painful, so that we curb our spending, curb our borrowing, and don't get too excitable. Because if they took the foot off the brake, then there is a risk that people would sort of start getting excited again, and you'd see that sort of spending and borrowing surge, and that would sort of push inflation up. So remember, there is an element of the Reserve Bank just keeping that tough talk in place so that people don't get a bit too optimistic. They do want us to be a little bit more nervous. So with that in mind, I think we just taking the forecast with a grain of salt is too strong a phrase, but we just need to remember that forecasts are forecasts. And that forecasting set is a really important tool that the Reserve Bank uses. One tool is actually moving the OCR, and they chose not to do that. But another tool that they can use is their set of forecasts and their guidance for the future. That is something we take notice of. That impacts market interest rates. That impacts behavior and expectations as well. So I think there is an element of the Reserve Bank just using that sort of forecast set as another tool to keep the brakes on just a little bit. But if things do change, if the economy slows, if unemployment continues rising, if inflation continues to come off the boil, they could change these forecasts at any point. So, what they're saying will happen in 2025 might not come to fruition, when we actually get to that point. So I think that's something you've got to keep in mind. And financial markets obviously agree with that because they haven't completely listened to the Reserve Bank. They are not pricing any chance of a further OCR hike in for 2024. In fact, they still see cuts coming in 2024, July or August being the most likely timing. So financial markets are a little bit cynical about whether the Reserve Bank will follow through on that tough talk, and I would agree with that. I can see why the markets have taken that viewpoint. So, from where we were a week ago, my worldview hasn't really changed dramatically. We'll just have to keep an eye on the data and see if inflation does keep coming down and if the labour market does keep easing. Maybe we will see a change of tune at some point. Who knows? What else did we have last week? Local business confidence. That was good. Continued rising in November. So you had this was the ANZ Business Outlook survey. Headline sentiment hit the highest level since 2015. Own activity, which is a better leading indicator for future economic growth, the highest since July 2021. So good news, businesses feeling better. This survey would have been mostly done before the coalition agreement was signed and in place. So I think it'll be the next survey, which is out the week before Christmas, where you'll see any change in reaction as a result of the policy mix that survived that negotiation process. But still great to see businesses in better heart. The inflation indicators in the survey didn't come down as much as I would have liked to see at the headline level, although it was pleasing to see the retail sector pricing intentions come down quite a bit. So that was business confidence. Elsewhere in the world, we had a really important inflation report out of the US, PCE inflation, personal consumption expenditures. This is the Federal Reserve's preferred inflation gauge, and it was pretty much in line with expectations. At the headline level, PCE inflation slowed to 3% annually, so that's well down from the peak from last year, which was north of 7. That's the lowest in about 2.5 years. Core PCE, still a bit stickier. This is the one the Fed watches really closely. That still came down though, came down from 3.7 to 3.5. That's the annual rate. And that is the lowest since April 2021. And probably more importantly, the last set of forecasts from the Federal Reserve had it slowing to 3.7 by the end of this year. It's already at 3.5. So they're ahead of schedule. That's important because we've got a Fed meeting next week. And this inflation report was the last big release ahead of that Fed meeting, last big release in an inflation sense, or a PCE inflation sense at least. Markets think the Fed is done. They think they're at 5.5 and there's no more hikes. And markets are pricing in the first rate cut potentially as early as March next year. So it will be interesting to see how the Fed addresses those market expectations, whether they play hardball like the Reserve Bank of New Zealand did, or whether they say, yeah, you've all got a point. Things are going in the right direction. While we're on inflation, we also had some Eurozone inflation out last week, and this was good news too. The headline CPE down to 2.4% in Europe, annual pace of inflation. That's the lowest since July 2021, and core inflation down to 3.6%. So again, core inflation a bit stickier, but still the lowest since April last year. And many of you will remember that European inflation pushed above 10%. It's 10 or 11% last year when the Ukraine war broke out and commodity prices went up and gas prices and all the rest of it. But partly because, and a big part because those commodity prices have come down, we've seen that come right back. So I would guess that the European Central Bank, like the Federal Reserve and like I and the financial markets believe is the case for the Reserve Bank of New Zealand, I think the ECB is done. There's no more rate hikes there with inflation coming down like this. And I think in 2024, you will see interest rate cuts in Europe as well. We had the US ISM index that came out last week. That was for November, a little bit weaker than expected, or unchanged from expectations, but certainly weaker than it has been in recent months, I should say. That wasn't a huge surprise. We'll be watching its services counterpart this week to just get a feel for whether the services sector is starting to feel a bit of that weakness too, because it's the manufacturing sector has been in a bit of a slump for a while now, but it's been services that has been holding up. So that is the one that I think will be of more interest over the next few days. Some economic indicators out of China. It was the PMIs, largely as expected, still pretty soft, still muddling through. And my guess would be that the world's second largest economy still needs a bit more policy support, and that you'll see that come through in the months ahead. Turning to what is coming up, the key release will be the US jobs report, and this is out on Friday, and this will cover the month of November, and it will be the final jobs report before that Fed meeting that I mentioned, which takes place next week. And I guess this is an important one because inflation's really key for the Fed, but so is the labour market, because the two things are interlinked. And we have seen some cracks starting to appear in the labour market. Last week we had the continuing claims data, continuing jobless claims that were at the highest level in almost 2 years. So that and other indicators that we've seen recently are just giving us those early signs that the labour market is still strong, but a few cracks are starting to appear. And the last jobs report was weaker than expected, and that pointed to similar things. Headline unemployment is at 3.9% in the US, so that's risen since it hit a multi-decade low of 3.4% back in April. So like New Zealand, it's still low in a historical context, but it's risen from the lows that it got to in recent times. So we'll be watching that. We'll be watching the wage growth, and I think this will be the big one ahead of that Fed meeting next week, which is the last of this year. So people will be looking for the Fed to either give them the green light that the recent rally can continue through to the end of the year, or they will be watching for the Fed to try and pour cold water on the optimism that you're seeing out there. So that will be an interesting one. Across the Tasman, we have got a Reserve Bank of Australia meeting that is on Tuesday afternoon, and there's no change expected to the Australian cash rate, which is sitting at 4.35%. They hiked a month ago, and that was the first one since June. They'd been on the sidelines at the 4 meetings in between, and it was just about nervousness about inflation not coming down as quickly as they would like. But we did get some good news in that regard during the week. We had the monthly inflation indicator report that comes out across the Tasman, and that saw the headline CPI rise at an annual rate of 4.9%. People were expecting 5.2, so it came in at 4.9, which is good, lower than expectations, and the lowest in 3 months. So any talk of a potential rate hike from the RBA this week sort of disappeared when we got that news last week. Next year, still a different story. I think the Reserve Bank of Australia might still need to do a little bit more on the interest rate front, much more likely than New Zealand or the US or Europe or the UK. All of those ones I think are done, and it's just a matter of when is the next cut, or when is the first cut, I should say. But the RBA the jury's out because they have had a bit more trouble getting inflation under control. Japan's the other central bank that still has some work to do. They're still in negative territory when it comes to their interest rates. So they definitely will have to tighten monetary policy over the next little while, but we won't be hearing from them this week. We'll also get a GDP report from Australia. This will cover September quarter, and I think that is out on Wednesday-ish. Our own GDP report here in New Zealand is due next week. So we've got to wait a little bit longer, and that will be for the September quarter too. But we will get the latest building work put in place and manufacturing figures for that same quarter, and they will influence expectations and forecasts from all the economists out there for what ours will look like next week. Other than that, there's not a whole lot going on. We will have the results of another dairy auction. These will be out early on Wednesday morning, and a couple of weeks ago we saw a slight decline, which is a bit softer than expected. That was actually the second decline in a row, although the declines have been very marginal on the back of that rebound that we saw take place between August, when prices had fallen to a 5-year low, and October. So we saw about a 15 or 16% rebound since August. So prices are still looking much better than they did a few months back. And I know a couple of economists out there are talking about the potential for Fonterra to increase their payout forecast, which is currently 7.25, which is lower than we've seen for the last 2 years, but it's probably okay compared to the 3, 4, or 5 years before that. The problem is that for the typical farmer, input costs have gone up quite a bit because of wages and interest rates and so forth. So 7.25 is not what it used to be. So if those economists are right and we are in line for an upgrade, that would be very much welcomed by the dairy sector. Not a lot going on the corporate front. We've had a flurry of results across the local market, and it's pretty quiet this week. I haven't got anything on my calendar. Across the Tasman, we've also had lots of results recently, and pretty quiet. A couple of names reporting or holding AGMs, but none of the big ones. And a similar story internationally as well. Fastenal on Wednesday, Lululemon on Thursday, but that is about it. So a few things to look forward to. Enjoy your week, team, and we will talk again soon.